Good afternoon. My name is Ala McCoy. I am Director of Startup Support at the University of Maryland's Ventures. And I would like to extend a warm welcome to all of you who joined us today for the next installment of Startup Fundamentals Workshop Series. Both live webinar audience and those watching a recorded version on our Startup UMD YouTube channel. This workshop series is offered by Ventures with collaboration from MTech at the Clark School of Engineering and the England Center for Entrepreneurship at the Smith School of Business. Everyone in the live session, please feel free to submit questions using the Q&A function or chat. You can find that usually at the bottom of your screen. We are recording this session and it will be posted on our Startup UMD YouTube channel. So if you would like to remain anonymous, you can submit your questions via the Q&A function and click the anonymous button. So today, I was just discussing with our panelists. I'd like to welcome Sam Handwerger. Sam is a lecturer at the University of Maryland's Robert H. Smith School of Business and an accounting and tax professional with decades of very extensive experience. Very much appreciative, Sam, for you to come and spend time with us and do several sessions on a topic that's applicable to startups across all industries. This is an important issue that all of us should consider. And thank you so much. And it's also very complicated, or at least people think it's very complicated. So thank you so much for spending time with us. The mic is all yours. I will monitor the Q&A. Please submit questions as they come into your head, and we will address them at the end. And thank you.
Okay, sounds good. I'm going to share screen if you can give me that capability.
Yeah, you should be able to do that now.
Okay, let's see where that is. Here we go. All right. Wrong screen, but it's got the right idea.
Yeah, I can see it.
Okay. All right, there we go. This is the right one. Okay, dokie. Today we're going to cover business tax credits, small business tax credits, some of which apply to even larger businesses than just a small business, but they're all good. And first thing I want to do is explain what it is about a tax credit that makes it valuable to you, either the startup business or an existing business. What does it do? So if you're in the world of business, you know, or even if you're just an individual taxpayer and you filed a tax return, you know that tax deductions do the following. They decrease taxable income so that the result is that you wind up with less tax to pay because your tax rate is based on the rate of taxation times your taxable income. And that rate is based on how high the taxable income is. We have this progressive system in the United States where you pay more tax as you make more money. It almost sounds like a disincentive to make money, but the highest rate is 37% on the income tax. So you still wind up, if you make more money, you still wind up with something left in your pocket. But that's the way the tax deductions work. And don't worry, I think, including myself, none of us in this, with all due respect, none of us on this Zoom right now are in that highest tax bracket. I think it's over $700,000 of taxable income. However, if you are, please stay after the webinar and speak to me individually immediately. I want to get to know you. Okay. All right. So tax deductions decrease taxable income, which affects the amount of tax you pay by virtue of the rate that you're in, whatever bracket you're in. We call these progressive rates tax brackets. And that's the idea of a tax deduction being beneficial, because if something is, quote, tax deductible, you'll pay less tax. However, unlike where you take the tax deduction times the rate that you're in order to understand how much tax it's going to save you, again, you take the tax deduction times the rate of tax, and that will show you how much tax you'll save. Tax credits, on the other hand, reduce dollar for dollar the tax that you'll pay. So if you have, as an example, $1,000 of tax to pay, that's your tax, but you have a $500 credit, get that to make it look like the 500. Then the result is you subtract the 500 and you pay only 500 bottom line. That means that tax credits can be very valuable. And I see, there we go. Here's the explanation I was drawing. These are the dollars that the tax credit goes dollar for dollar. So if you have a tax of 1,500 of credits, it reduces your tax to 500. So unlike deductions, which are based on the rate, tax credits are more valuable because they actually reduce dollar for dollar the tax that you're going to pay. Therefore, all tax credits are interesting to know about. They may not apply to you. They may not even be something you're interested in, but to know what they are makes good sense. There are many different tax credits out there. We won't be able to go through all of them today. I'm going to concentrate on ones that I think are more appropriate for the small business owner. They all fall under what's called the general business tax credit. All that basically means is that you use it as needed when you have tax. And if you can't use it in 1 year, it carries over. That's another reason not to miss tax credit, because if you can't use it in a particular year because you have no tax, for example, you're a startup company. What do startup companies do? Traditionally, they maybe don't have profits right away. So here, in this case, you can use the tax credit on an as-needed basis, and it carries over. Most small business tax credits are non-refundable, meaning they're only available to reduce tax. You may be familiar with the concept of refundable tax credits. The child credit is one example of that. The earned income tax credit is an example, where some of the money of the credit comes back to you even if you don't have a tax, or if you've used up any of your tax with some of the existing credits. But in the small business world, these are all non-refundable, but they're reducing taxation. They're reducing the tax dollars you might otherwise have to pay. The first one I'll cover is one that is the first one I ever worked on, called the Federal Historic Tax Credit. It is not seen as much as it was years ago because they narrowed the definition of what a federal historic tax credit is available for, but it's basically a credit that incentivizes business owners to preserve historic properties. It has to be for a business. It can't be for just a residential property where you're going to live in it. But if you come across a building, for example, the now sort of hotel down in DC known as the Watergate Hotel. Watergate Hotel has significant historic significance. There, I said that twice. In the United States history, you may know. And therefore, the owner, when they bought the rundown version of the Watergate Hotel and rehabilitated it, was able to get a tax incentive for doing that. After all, the property was in pretty bad disarray when he first bought it. So this is good in the United States for a way of creating an element of preserving our historic structures. It must be a certified historic structure. That sort of makes sense. And you're going to start off with a division of our federal government that you wouldn't expect to start off with for a tax credit. You're going to start off with the National Parks Service. You'll make your first application there to find out if this particular historic structure is indeed a historic structure, making sure it's on the list, that they're aware of it, and the application will describe what you want to do, and then they would approve your plans and work with you in terms of what exactly your renovation would be. Most of the renovations will preserve a lot of the outside structure, but the inside could be completely new in many cases. As what is the case with the Watergate Hotel, the rehabilitation side was like a 90% clean out of what was there. And you will own the building or directly, or you might own it as an investor. This is what means pass-through entity. We're going to define that now because it'll come up in many of the future slides. So we're going to define that. And you're eligible to claim the credit. So you might be the direct owner of the property or an investor. That's really what this means. Let's take a look at how this works, because it's going to yield fruits from our labor here when we get towards the end, when we have a specific example of how you might structure a tax investor, a tax deal to attract investors. So a pass-through entity, which is about all the entities that are going to apply for today's lessons, pass-through entity means that it is not a tax-paying entity. That sounds really cool because everybody would love to be involved in an entity that doesn't pay tax. Not a tax-paying company, but the taxable income that is computed passes through to the owners. So the owners pay it at the individual level. Let's say that again so you can get the concept. The entity itself doesn't pay tax, but all of its taxable income or tax benefits, tax credits, pass through to the individual owners, and they put it on their individual return, paying the tax there or taking advantage of any credits that pass through. So hence, if the credits for a rehab of a historic property pass through, they pass through to individuals who get to claim those on their individual return. So we'll just do, so it passes through to your investor. And that's the key to attracting investors with a lot of what we're talking about today, not all of it, but a lot of what we're talking about today, where you're going to do a project that has a tax credit to it, and you're going to pass that tax credit to the owners to help insulate them from the losses that the property or the business might otherwise have. Let's just summarize this now. Again, we're going to do a comprehensive example at the end, but for the moment, just so you get the feel for what this is all about, suppose you get an investor who comes in and puts their hard-earned savings into your business. So it's your business, but they're helping you fund your business. So for that, you're going to give them through your pass-through entity, and right now we'll put that at, we'll call it a PTE, pass-through entity. You're going to give them the income that might be generated because they're an owner, a part owner with you, call them a partner if you will. You're going to give them the income to pay tax on, their share. You're going to give them any cash flow that's available. After all, they are a partner with you. And you're going to give them these tax incentive credits, their share, to help them reduce their own taxes. And that's really how you're going to structure the deal in a real simplified sense. And that's nice because it does incentivize the investor to come on board for the purpose of A, getting a tax benefit, B, getting some cash flow, and of course they'll have to pay tax on the cash flow itself, basically the income, but they will get a return on their investment plus credits. And the credits do the following. Here's the key. We'll do the key now, and then we'll come to the comprehensive example at the end. The credits give the investor an immediate tax savings such that they're already ahead of the game. Suppose they invest $100,000. Let's do it this way. Suppose they invest $100,000. I'll stop share for a minute so I can see the screen of myself. Okay, but suppose your investors invest $100,000. Now, if they get a tax credit of $20,000 right up front, because the deal that you have, like the historic tax credit, could be a $20,000 tax credit for $100,000. It could be worth that much or more. Now they've got $80,000 invested. They've only, for 100, they got $100,000 investment, but they've got $80,000 back from their taxes right from the beginning, reducing the risk of their $100,000 investment. Hence, that's why looking at tax credits to attract investors has a lure to it. And now the question is finding for your type of business the right type of tax credit that might apply to that. That's the nature of the ball game, because they're not all the same. They're not all going to apply to every small business. We're going to see where if we can find some that do. Okay. All right. On that note, what I'd like to do is go through, I do have an order to the slides, and they may not hit all the points that we just did in terms of attracting investors, but let's go through and see what we got here. All right. So still staying with the historic tax credit for a minute, just to show you um, the applicability of this. It's you can lease a building and you can still be eligible for the historic tax credit. So you don't have to be the full owner of it, but leasing it might be available, or finding a lessee that you own the building of who does the rehabilitation, the historic rehabilitation, and they can get the credit. So it's got some nice features to it. If it happens to be that where you are going to set up shop might just be an older structure, in fact, an older structure such that it's on the list of historic sites and buildings in the United States as certified. Okay, there is also state historic tax credits, and you can put the two together and get the best of all worlds. Most states do have them for the purposes of preserving older buildings in that state. There's also some energy and reforestation investments. We'll come to the energy part later. For the moment, just leave it at if you are needing to cut down a lot of trees or you're involved in something in the foresty way of town, wherever that might be, check that out. It's not a big one, but it's still a potential credit. Okay, work opportunity and welfare to work. Now, we're going to go through these next slides quickly so we can get to the ones that might be appropriate for attracting investors. These next slides are credits that are available to small businesses that may be very meaningful to you when you're still in the small business mode, because you might be saving some significant money. So the work opportunity and welfare to work is if you hire employees who have these barriers to employment, you'll see with the list that we're going to show you why that might be the case. If you hire them, then you're going to be eligible for a tax credit based on how much you pay them. Let's see what the categories are. I'll let you just skim this. You can while you're doing so, you can probably see why there is a tax credit for this. It's the federal government's way of encouraging these individuals to get hired where they might otherwise find themselves at a disadvantage to get hired. And you will know if your particular employee or potential employee falls into this category because they get certified by the state. So they might say to you, well, I'm one of these categories, but they need to be certified by the state that they qualify for this credit. It's not hard for them to get that done. They just have to go to the right state agency. And when you hire one of these people, you get a maximum savings of $2,400 off the cost of your payroll. So it's a 40% credit on the first $6,000 of salary. So the first 6,000. It's not a huge amount, but if you have a lot of employees or you want to hire an employee, and you can hire somebody who may be qualified for the job but might be one of these 10 categories, it's a worthwhile way of reducing your cost, small business owners. Alternative fuel credits. I don't really deal with these, but I wrote them down so that you might know in case anybody from our engineering school is involved in doing something with biofuels, biodiesels, whatever these things are. If you're involved in that and you're already not aware of the credit, now you know to do some research, check with the CPA and get more information. All right. We're going to cover this in detail on December 2nd. For now, I'm just going to mention that this is, by the way, and the way I'll do it, I'll put a little asterisk. That's a number sign. Okay, you get the idea. This is telling you that this is a potential for getting investors. The research and development, the R&D credit and R&D expenditures that are available to help reduce income and create tax incentives for investors is something on December 2nd, when we cover that, applies to the theory of what we're talking about today. It's a separate seminar by itself because it's rather complex and it's also going through some changes as we speak. Disabled access credit, you have a site where you have a little building for your business or structure. If you need to create accessibility for disabled individuals, it's a pretty wide definition. So I would invite you to take a look at who might apply to, and it covers 50% of your expenses to a maximum of $5,000, because it's $10,250 after the first 250, or yeah, so you wind up subtracting the 250s. So it's 50% of 10 basically. But again, if you have an employee situation who maybe, God forbid, but wheelchair bound, and you need to provide a ramp, and the ramp's going to cost you 10 grand, well, now it's only going to cost you 5. All right, maximum tax credit is 5,000. That's how it's calculated for the record. All right, this one, again, this does not, can attract investors, I suppose, if you're doing rental vehicles. But if you have a business that's going to require a car or a truck in some nature, and the car or truck will be dedicated to the business use greater than 50% of the miles that it travels during the course of a year, then the qualified plug-in electric and electric vehicle credit could be very meaningful to your business. Now, these credits also apply for non-business owners of these vehicles as well, but it's I encourage you not to forget about it in the situation of your business asset. So it's just another tax incentive to buy the electric vehicles, courtesy of our federal government. It's not a huge, well, it's not too small. It's worth between 2,500 and 7,500, and the dealers are going to know. The car dealers, the truck dealers, they're going to know how much is available for each particular vehicle. So you'll find it out. You'll find it out when you're shopping with the car salesman. All right, and if there's any question, you go to www.fueleconomy.gov, and they have a bunch of information about these vehicles and the tax credit thereof. Alternative motor vehicle credit, it expires at the end of 2024. What is it? It's a credit per gallon of what you pay per gallon for these following types of fuels to drive a vehicle. Okay. I don't know anybody in my clientele that has used this credit, but given the fact that I think we do have some engineering students from time to time, I thought I'd humor you with this. Entertain you. That's a better word. Okay. All right. Now we come back to potential credits for the purposes of gaining investors, the empowerment zone employment credit. Let's take a look into this. If you hire someone who lives and works in a low income area, you get a credit up to $3,000 for each full or part-time employee. So this could be an attraction to an investor, particularly if you're going to be a small business startup with numerous employees. And that's possible, particularly if you're in the high-tech arena where most of your work is done by employees. You're going to be hiring a number of employees. So this credit could be an attraction to potential investors, where the credit will go to them through that pass-through entity that we talked about earlier. So again, this is the empowerment zone. It has to be in these empowerment zones, and where you're going to be located is you're going to be located in a fairly demographically challenged area. How will you know? The EZ zones, or empowerment zones as they're called, the state of Maryland, and every state has, you go to their website, you'll be able to find where they are located within the state. I'm not going to spend a lot of time on this because it's usually the areas where this applies to are very difficult. They're so demographically challenged. It's very difficult to get a startup business there that has any real degree of, let's put it this way, has had a history of success. So it's been used, but it's not been one of these credits that's had a great track record. Nevertheless, it's out there. Don't discourage people from taking a look to see if it might apply. A couple more credits before we get back to the investor type credits. You get a credit for employers' Social Security and Medicare taxes paid. What this amounts to, just quickly, is talking about what we call payroll taxes. When you pay an employee, $1. Here, Mike, here's $1. Go to work. It costs you another 7.65%. So it winds up costing you $1 and call it 8 cents to round it off. That's a payroll tax. The employee only gets the $1, but the government gets the 8 cents. And that 8 cents goes towards their Social Security and Medicare for later on when they go to retire. That's a different story, but you get the idea. It's a payroll tax. You can save on these payroll taxes if you're a small business owner under the following situation. You're in the restaurant business or also basically the food and beverage industry itself. And if they receive tips, then you, through a complicated formula, you can save some of the Social Security and Medicare tax on the tips that they get. The next administration has somewhat vowed that they're going to get rid of tax on tips to begin with in this industry, in which case this credit will go away. Now, one that's really important for small business owners to attract employees when you're trying to put together a nice package is this credit for small employer pension plan startups, because this will help you get a 401k set up with where you otherwise might have to spend money to do it. This is going to help you. It's worth $500. Again, not a huge amount, but it doesn't cost a huge amount in most cases to set up a 401k plan. Nevertheless, if it costs you $1,500 with a third-party administrator to do it, and you can get it down to $1,000 by getting a tax credit for $500, hey, go for it, right? And so this will help you if you're just starting off or you don't have a pension plan yet, and you want to make sure your package is competitive with the industry. This is a great incentive. Don't miss it. Won't spend time on this because I think a lot of startups aren't into this at this point, but just so you'll know, there is an employer-provided child care credit. If you are going to spend money for the child care of your employees while they're at work, you can get a 25% of those expenses. And it's a fairly steep curve before you run out of those credits because it goes all the way up to $150,000. So it's not just for the small businesses, it goes all the way up to medium-sized businesses. And it's a great incentive to, again, attract employees by having employer-provided child care on site. All right. Credit for small employer health insurance. I'm just going to skip through this because I just want you to know the concept. If you're trying, again, these last few slides do fit together. I hope you see that, where they're trying to help you tax-wise to set up a package for your employees that will be attractive to them and yet save yourself some money in putting that package together. So here's another one, the small employer health insurance premium. It's for 25 full-time employees or less, or fewer than 25. So it's up to 24 works. All right. And family and medical leave credit, again, same concept. You can now add this to your payroll package, knowing that it won't cost you as much as you otherwise might have thought so. All right, let's move on in the interest of time. Now we're going to spend the rest of the seminar. I want to take a breather with you, see if there's any questions in the chat rooms thus far.
Yes. So the first question, how does the pass-through entity apportion the credits to the partners?
Usually you're going to apportion those on an economic basis, meaning if you put in 10% of that's a great question. If you put in 10% of the total cost and they put in 90%, you get it. They're going to get 90%, you're going to get 10%. The tax law, fairly complex, not fairly, really complex. But the basic idea is that the flow and allocation of expenses or losses and credits should all follow the economics of the deal. So if an investor is going to get 90% of the cash flow, they're going to get 90% of those tax credits.
Thank you. And the next question is, are there any tax credits for National Guard service members?
Wow, probably. And do I know what those are on the top of my head? Well, there's not a lot of hair on the top of my head, so that's that gives you that answer. But I can certainly do the research. If you, Allie, if you put my email out for everybody, and they want to do these office hours ad hoc already, I'll be glad to sit down with that individual.
Okay, thank you. I will post Sam's email address, and we're also planning to host office hours in the future where you can actually come in and have, like, I don't know, 15-20 minute session. We haven't discussed the details quite yet, but already advertising them. So thank you, Sam. Let me post your email address. I think those
No
are all of
problem.
the questions that I see so far.
Okay. The basic idea, everybody, is that I'm going to be available for one-on-one sessions to help answer any specific questions that you have. Obviously, limited in time, no cost, which means no profit to me. That's another reason for limited in time. Okay.
Yeah, thank you.
All
And
right.
then
No problem.
also wanted to quickly mention that I posted the link to the December 2 session. Anybody interested to sign up, you can register right now or grab the
Super.
link. Here's the email.
All right. We've got a little less than a half hour to go. I'm going to move this quickly and so I can get to the overall approach at the end and we cover everything here. Hold on to your seats. New markets tax credit. Now we're going to come to the big ones. In addition to that historic tax credit where we started, that was a big one. Here's some big ones that probably have a wider audience than just the historic rehab credit. New markets tax credit. Provide capital to community development entities, CDEs. So what are they? These are entities that are going to invest in certain particular areas within a jurisdiction within the states, and it's going to create credits against the tax obligations that the investors have. So the investors come in, invest in a CDE, they get a tax credit for doing so, and the CDE is going to lend the funds out to those businesses that are in the right area eligible for the quote unquote new markets tax credit. Again, a lot of these are now developed for geographic purposes or particular types of individuals demographically in order to attract small businesses to those areas. So what happened, and here's just an example, is that the eligible areas fall within this category. They're defined as 30% above the poverty rate and 60% below medium income in the area with an average. This was for 22. It may have changed slightly with inflation, but you get the idea. These are pretty difficult areas for small businesses to come in and find people to hire. It's a challenge, and in order to attract those small business owners to those areas, that's the new markets credit. So there are four key players in this. We'll just go through these quickly and come to the bottom line of how it would apply to you. There's what's called the qualified active low income community businesses. This would be you. If you're qualified for it, could be for profit or nonprofit. So you would first want to define what does it mean to be a qualified active low income community business. And then if you are, and most will fall into that, we'll give you some idea. You then go to the community development entity, which is the intermediary. This is where you go to. You go there to apply for financial assistance. Where do they get their money from? They get their money from the community development financial institution, from the Treasury Department that helps set these up. And of course, the majority of the money that comes in here comes from investors looking for the tax credit associated with the new markets tax credit. So that becomes the funders, and there are usually banks, financial institutions, because they're the ones that have great tax liability. If you didn't know already, they have a great tax liability because they're making lots of money. They deal with money and they make money. So we'll say large tax liability. All right, we don't need to know the credit, but just for the purpose, it's a 39% credit over 7 years. And what the CDE will do is they'll lend to a business that qualifies they'll lend about 25% of the total project costs. So if you got a $100,000 startup budget, you might be eligible for 25% of that to help you get started from a CDE. So you'd have to find out where a CD is. Your banks will know, by the way, since they're major players in buying the credits from the CDE, that they will know. Then you must put your business into a low income community where the poverty rate is 20% or higher, median income is less than 80%. These might just be changing over the course of years, but you get the idea. You'll have to find out for sure what the requirements are in the particular year you're doing it. And these are the types in 2022, by the way. These were the startups that applied for a new market help, and we'll see what that is in a second. You can get an idea of what kind. This is the number that year. Most of those manufacturing, healthcare, grocery stores. That was one of the incentives of the new markets tax credit, is to bring food to otherwise what they call food desert communities. Here's some other examples: restaurants, schools, museums. You get to see how it's intended to do some nice things for a community that's otherwise challenged, and it looks like it's being fairly successful. All right, so what is it going to be? It's going to be a loan to you. The loan will have a benefit. So this is not one where you're going to create investors. That's not what's happening here. That's not this case. What you'll be doing is you'll be borrowing money from the CDE under the new markets tax credit concept. You'll get below market interest rates, flexible terms, higher loan to value ratio. It's an easier way to borrow money for your startup than going to a traditional bank, because traditional banks have some difficulty for those types of communities, as you can imagine, due to the risk involved. It expires in 2025, unless it gets extended by Congress. There might be some money there in 2025 that might be needed to be given out, and you might find it beneficial to check on that if it applies to you. All right, next on the list, here's where we are going to use an investor. So this is an investor type tax credit. So let's get into the meat and potatoes. It's called the Low Income Housing Tax Credit, LIHTC for short. And it's going to be an incentive to construct or rehabilitate rental housing for low income individuals. Like it sounds, low income housing tax credit. So if this is you, you're in that kind of business, this is going to be a great way to attract investors. The federal government gives the credits out to the states to administer to the areas that they identify as being ripe for low-income housing tax credits. The agencies award them to private developers of affordable rental housing projects, and it's done through a competitive process. So you basically go to the state of Maryland or wherever you are and find out where are they looking for proposals to produce low-income housing projects. That's what you would do. All right, and then as a developer, you sell the credits to private investors. So your project gets the credit, it gets awarded the credit, your project gets awarded the tax credit, and what you do is then you sell those credits in exchange for an investor to come in. That's where your money will come from to help. Won't be all the money, but it could be a good portion of it will come from those tax credits that the project yields that's been awarded by the state. You'll sell those credits. There's a market for selling the credits. It's pretty easy to do, and so that'll bring in the dollars for the investment. But these will be real investors. They'll be owners with you, like we saw in that pass-through example early in today's webinar. That's what these people are going to be. And so they're going to be beholden to you for a successful run on the project. You're going to have to try to sell them when it's going to work. Not always so easy, but these are the types of properties, rental properties, that it would be. You can get an idea. So it's not for everybody as a way of making a living, but the federal government is incentivizing people to do it. And there has to be a test income test for the tenants. You can't be having a requirement that they have $100,000 of income in order to be a tenant. It's for low income paying individuals. So you're going to be actually looking the opposite way for people who don't have a lot of income to become tenants. And it'll be affordable housing, basically. Computing the credit, just to get an idea, it's a percentage for the new construction is 9% roughly. So if you spend $1 million, you can get an idea how much the credit is worth in terms of selling. And it's dollar for dollar. You'll sell the credit pretty close to dollar for dollar. So if you got a $100 credit, you're going to get close to $95 on the street for selling that credit. Okay. If it's just rehabilitation, the credit's worth 4%, a lower amount. There's the kicker, sell the credits to investors, and okay. So the investors often put in more money than just what the credit would be. You can make that a requirement depending on your ability to sell your particular project to investors, because they may actually put in more than just buying the credit as their contribution to the investment. The syndication here or partnership, that refers to those pass-through entities that we described at the start. That's what it means. Okay. Now, for the record, with these PTEs, these pass-through entities, the investors or limited partners play a passive role. They don't run the property. They sit back. They don't really have a whole lot to say or rights to say anything. They don't have necessarily voting rights, although they may have some. They're there mostly to receive the tax benefits, and you run the show. As with the new markets tax credit, the same thing here. Most of these tax credits are going to be sold to corporations, financial institutions who have the tax liability and the money to buy the credits. Same thing with the historic tax credit, by the way. And again, the good news about that is it's a ready market. It's easy to find. Just go to a major brokerage house, major financial institution or bank. All right, moving on. For the record, the low-income tax housing credit can't be claimed until the project placed in service. Not unusual tax law. All right, same idea for investors. Opportunity zone investing is sunsetting because it's going to expire at the end of 26 unless extended, but it's still a very viable option out there to make use of the opportunity zone. So let's find out a little bit more how it works. To the investors, it's an attractive way to grow tax-free wealth. Let's see what you would be selling to potential investors if the opportunity zone investing is applicable to you. And this is one where it's very possible that it might be something you can use. So let's put this one down as a big, with a big asterisk this time. There you go. There's the asterisk. This might apply to you to use the opportunity zone. So what you would be offering to investors is they sell a property or a business where they have capital gains. They reinvest those capital gains with you, with your business. They don't have to pay tax on that until the end of December. So that's number one. Now, you don't remember these things just to get an idea of what tax benefit you're going to be offering to potential investors. It gets a deferral taxes. Not having to pay the taxes today is nice. People love that. I don't mind paying later, so they say, but they don't mind the deferral. It's paying the taxes is the painful part. So if you can push it off, they love that. But then, more importantly, they're now an investor owner with your business through that pass-through entity. They're now an owner with you. And here's the deal. Based on what they've bought with their reinvestment, with their investment funds, where did their investment funds come from? It came from a capital gain on something they sold. Now they're reinvesting it all with you, with your business. And if your business does well in that opportunity zone, and they hold on to it as an investor for 10 years, which is great. Now you don't have to worry about the investor wanting to get their money out, get their return. They will be wanting to hold it for 10 years because if they hold it for 10 years, whatever the gain is upon sale of that, or whatever, is zero tax. So this is a big wow. This is a big way of attracting investors to your business as a way of saying, hey, look, invest with me. We're going to do well. You're going to be able to sell your portion of it 10 years and a day out, and you won't have to pay tax on what you get for it. And it's going to appreciate. It's going to be great. So now to know whether this is going to apply to you, what types of projects are being financed, let's see what they are. So it's commercial and real estate, it's housing, it's infrastructure, and then it could be you because it's existing or startup business investments. So it's a whole wide variety of potential projects. For real estate projects, must be substantially improved. The requirements are minimal compared to other financial development tools. But this may be something that works for you. You will have to do it in the opportunity zone area. You'll have to do it in the opportunity zone area. And it is an equity investment. It's not a loan. They become owners with you. The money will come from a qualified opportunity fund, which can be investing in all types of entities, all types of businesses. It's attracting capital as we speak because now they're getting into oil and gas production in the United States, but there's a whole host of other types of businesses that they get into. Apartment building, medical facilities, hotels, even oil and gas, and the list can go on and on. So it's not something you should dismiss as a possibility. All right. Federal solar tax credit works for businesses. Yes, it does. It's 30% of the solar energy systems. This is huge. This is a huge way to help your existing business because this is just for the solar panels themselves, basically. It must be new. And again, it's 30% of the cost of a solar energy system. That's a huge amount. And it includes the labor and the storage of the panels and whatever has to go into it. It's a huge thing. There's a Maryland credit program as well. My understanding is another 30%. You could almost wind up not paying for any of it and get a whole huge solar panel. Okay, so this is a little bit more about it. This is the Maryland requirements. We don't need to go through too much of this. It basically mimics the federal. Then on top of this, there's a production tax credit producing energy that can be stored. So you use the solar tax credits to cover your upfront costs of solar installation, and then take advantage of what's called the production tax credit to store electricity. It's basically you sell it back to the power companies, and you get another credit. So and you don't have to be in the business of solar. You can just be in a business of putting them on your existing roof or your parking lot or wherever your business might be located. Put up those solar panels, and all of this could apply to you. All right, so let's see. Maryland business taxes. Let's go through this because I want to get to in the last 10 minutes to the big part about how these programs would work if you're going to do some type of tax credit or just bring in investors for what we call depreciation. So here's a couple of Maryland things. Maryland has a job creation tax credit, has a research and development tax credit, more on that on December 2nd. It also has the enterprise zone tax credit like the federal government. And then especially for our engineering participants, they have a biotech investment incentive tax credit. Take a look at that. Inquire with your local CPA. And there's your solar panels. Okay, let's find out what these deals look like. So if you're going to attract an investor, you'll know what you're possibly getting yourself into. What you're going to be doing is selling tax credits. It doesn't have to be the clean energy tax credits, but you'll be selling tax credits to attract an investor. So that's the key. You'll be selling that to them. You might also be selling depreciation. More about that in a second, because depreciation shelters income. Depreciation is a deduction, and that deduction means that your business might be making money, but no tax to pay. It's not taxable income through its depreciation that it might otherwise have. We'll skip through this because there's some new credits that came out under Section 45X, but it's a lot of It's very much toward the manufacturing facility area. So we'll skip over this. Okay. All right, here's a real estate investment deal summary. And you'll get somewhat of the idea of what attracting investors, even for tax credits or depreciation, might look like. And for you, I would just say up front, before we go through the details, you don't have to be necessarily real estate for this to apply to. You could be investing in equipment that has depreciation to it, and all equipment does. So it might have depreciation that would be attractive to an investor. What that would be is depreciation that can happen in the first year. And for a lot of small businesses, the depreciation can happen all in the 1 year of purchase, because you're not buying over $150,000 of equipment or something along those lines. You might be just buying, I'm sorry, not 150,000, a million, like a million. I think the number right now is like 1,250,000. So you might be just buying that much equipment or less, and it would all be subject to the first year of depreciation under Section 179. And the result would be you get to attract an investor who would get some of that depreciation allocated to them based on their investment, and that would shelter them from any income coming in during the first year. Here's what the structure looks like. Let's just take a look at a more typical real estate investment, but it could be for anybody, and the terms could change. $100,000 minimum. You ask the investor to hold for 5 years. You expect that at the end of 5 years, you'll be able to, quote, pay them back their initial investment. What they would get in return is they would begin getting cash flow at the second quarter. If there is cash flow, they would have a 1 year 6% cash on whatever cash they put in return. They might not get that, but they'll accumulate an account saying they're owed 6%. And years 2 to 5, there'll be a projected 7 for 8. Their overall return would be considered 8%. So you can sort of just say this is just cash flow. This is cash flow. The end of the day is they're going to get 8% on their investment plus their investment back. So it's an 8% cost to you to attract these investors, plus the depreciation that will go to them and any tax credits that will go to them. Usually this winds up with an internal rate of return of somewhere between 15 and 17%, maybe a little higher. So it becomes a 2-for-1 deal. They put in 100, they get $200,000 back. And if there's any tax incentives, then it just increases the overall return and incentive for the investor to invest because it's tax savings. All right, just so you get an idea how we interpret internal rate of return. This is the investment. This is the cash coming back, cash flow over a number of years, yielding an internal rate of return of almost 57%. Very, very high. So that would not be most deals, but it just gives you an idea that what does it mean in IRR is you take into account what your initial investment was and then the cash flow you're going to get over the course. Tax benefits. All right, so you might have depreciation. This is what this is referring to. The first two items is saying depreciation is a deduction. It's not cash. Depreciation is a non-cash deduction. It's going to be allocated to your investors in a nice way. Your investors can exit through 1031 exchange if it's real property. It's not for every business, but for real property. So we'll say real estate. Operating losses pass through to the investors, shielding them from the income that might occur later on with the investment, particularly the gain, and they get the tax credits or other incentives that the government program might have. And this might be what the structure looks like. There might be capital that they send in where some of it would be called like, we'll call them A investor, where it'll look like debt, it'll mimic debt, and then which is senior gets paid back first, and then the second tier, second tranche would be equity. And you can see the general concept is 90-10. Limited partners, the investors are usually 90%. You can become, this is you, by the way, You're the general partner. You're the developer. You're the guy who put the business together. You can become more than 10% if you put money in. So if you put skin in the game in addition to your development of it, you can get more than 10%. But imagine if you just get 10%, but you didn't put any money in. So the total money is $1 million. Well, 10% of that is yours if you're successful. So that's gives you an idea of the coolness to this kind of structure. The profit split becomes after the 8% preferred return on their initial investment, it's an 80-20. Now, I know it came in at 90-10, but if you're successful, if they get this, see, this is success. If they get their 8%, then guess what? Your 10% goes up to 20%. That is like your bonus for making the deal successful. This is a somewhat very typical type of way of setting this up. And of course, they get back. This is just the profit. The investors get back their 8% plus, I want to make sure you got this, plus their investment. So if they get back their initial investment plus 8%, and there's more profit, now your take of that profit goes up to 20% because you did it. And if it's a real property, if it's real estate, the investors can get out through a 1031 exchange opportunity. You can get your investors out through refinance. If you can get a bank to lend you the money to pay them out, you can pay them out, give them their 8% return, and they get none of the profit because there is no profit. You didn't sell. You just buy them back. That's really cool. Or you sell it to an institutional buyer. A lot of times, they're depending on the business that you operate, they're out there buying those institutional properties, and the result would be your investors will share in the profits from that sale. But this is like the key to real estate, by the way. Not that it can't be your business. This is a key to real estate because you can refinance real estate, goes up in value. You can get your investors out by just paying them their 8% and their return of investment. And you are in the driver's seat for all the profit. Okay. Questions on the floor?
Thank you, Sam, so much. This has been fantastic as always. There are a few more questions. I know we are almost out of time.
I can save
Question.
a few more minutes.
Okay. Question one is, my startup has been spending some of our funds on R&D design work. From my understanding, those costs must be capitalized and amortized over 5 years
Amortized. Yeah.
instead of being a traditional expense and being deducted. I understand that R&D tax laws are being changed at the moment.
Yep. Tune in to December 2nd. That's really when I'll cover that. But they are essentially correct in what they've said in their question. But come back for more on December 2nd as we delve into the current situation, and we'll actually take a peek at what the smart money thinks is going to happen with the R&D.
Yeah, thank you. And I posted the link for everybody to sign up for the December 2nd session. So, yeah, interested, please do so. And those watching this on YouTube, look for another video on YouTube that's titled R&D tax credits. All right, one more question is, let's see. Can you add a premium to sales of LIHTC credits? How do you document the credit for sale?
You mean when you sell the credit, you're going to sell it on a marketplace that is a marketplace controlled by basically the institutional buyers of those kinds of credits. And you'll never sell those at a premium. You'll always be selling them. Well, let me say this. I've never seen them being sold at a premium. It does fluctuate, goes up and down. Currently, it is a fairly close to dollar for dollar sale, but it's never quite that because the person buying the credit doesn't want to just trade dollars. If I buy your credit for a dollar, I'm not any better off. So I want to buy it for something a little bit less. If I can buy it for 95 cents or 90 cents, I'm getting a 5 or 10% immediate return on my purchase. That's the incentive for them to become an investor with your somewhat riskier what potentially riskier investment opportunity because I can get that kind of return on my initial investment through that tax credit. So normally it's at a discount.
Okay. Yeah, thank you so much. I think that's about it. Thank you so much, Sam. As always, very informative session. And please, I hope that everyone here will tune in on December 2nd. And again, thank you so much and have a nice day.
Thank you.